All right, Steve here. I've spent decades in the trading pits, and let me tell you something, the market is going to challenge you. It's a guarantee. But see, winning isn't about being right every time. It's about knowing exactly what to do when you're wrong. Today, I'm going to show you how a pro stays in the game and how we can turn a trade that's going south into a winner.
This right here, this was gospel on the trading floor. It's a mindset. Look, a loss only becomes real when you hit the button and close out for less than you put in. But what if you could adjust? What if you could actually improve your odds and get paid for the trouble? That's not some fantasy. That's a standard play in the professional's book.
Okay, so let's set the scene. It's a classic situation every single trader hits. You've got a position on, you did your homework, you felt good about it, and then the market decides it has other plans. The price moves against you. Now, right now, this is the moment that separates the amateurs from the pros.
Let's make this real. We're looking at a trade in NVIDIA. We sold a put, which is just a fancy way of saying we made a bet that the stock would stay above $130 a share. But, well, look what happened. The stock dipped down below our strike price. The position is now in the money, which is trader talk for being underwater. For most people, this is when the panic starts to set in.
And what's that first instinct? For 90% of people, it's panic. They see red on the screen, and they either dump the trade immediately for a loss, or they just freeze, kind of hoping and praying for a miracle. A professional doesn't panic. A professional has a playbook. A professional pivots.
And that pivot, it has a name. It's called the roll. Now, let's be very clear. This is not a desperate last-ditch Hail Mary. This is a core, strategic move. It's how we manage risk, how we buy more time, and how we turn a losing hand into a winning one. So let's break this thing down.
Now, the most important phrase on this slide is a single order. This isn't two clumsy separate trades. A roll is one clean, efficient action that does two things at once. You're closing out the position that's giving you a headache and opening your new, better position at the exact same time. So here are the mechanics. It's a 1-2 punch. First, we buy to close the put we originally sold, the one that's underwater. That gets us out of our immediate obligation. Then, in that very same order, we sell to open a brand new put. But here's the kicker. We push the expiration date further out into the future, and we drop the strike price down to a safer level. And here's what that order actually looks like on the trading platform. See that? We're buying to close our March 130 puts, and at the same time, we're selling to open new puts that don't expire until April, all the way down at the 125 strike. One order, two game-changing adjustments. Okay, executing the move is one thing, but there's a principle behind it, a rule that is absolutely non-negotiable. If you remember one thing from this, make it this.
I want you to burn this into your brain. You do not pay to fix a trade. Think about it. You are agreeing to stay in a trade longer, to take on risk for more time. The market should pay you for that. If the numbers don't work out where you're collecting cash, a net credit, you walk away. You take the loss or find another way, but you never, ever pay to roll.
And in our NVIDIA trade, the math works. After all is said and done, we collect $150. That's cash in our account. The market literally just paid us to give ourselves a better position with more time to be right. That's the rule in action. The credit is great, don't get me wrong, but what that credit allows us to do is even more valuable. With that one move, we've just bought the single most precious asset in the world of options trading, and that's time. We call this the theta reset. By rolling to a later date, you're essentially hitting the reset button on the time decay of your position. You're giving your trade a whole new lease on life. More time for the stock to recover, more time for the math to work out in your favor. So here's why that matters. Theta, or time decay, means an option loses a tiny bit of its value every single day, like an ice cube melting on the sidewalk. Now, if you bought that option, theta is your worst enemy. But for us, as option sellers, theta is our best friend. And by rolling, we just gave our best friend more time to do its job, which is to make the value of that option we sold slowly waste away. That erosion is our profit. So, we did it. We executed the roll, we collected our credit, we reset the clock. But what does that really mean? Where do we stand now? Let's analyze the new position. Just look at this side by side. It's night and day. The old position, we were on the hook at $130 with only 26 days left on the clock. That's a tough spot. Now look at our new position. We've got a $5 buffer with the strike down at 125, and we have 54 days for this thing to work out. It's a completely different ballgame.
So let's just tick off the victories here. We lowered our risk by moving the strike down $5. We bought ourselves an extra 28 days. We got paid to do it. And maybe most important of all, our break-even point is now way, way lower. We just dramatically increased our probability of this trade being profitable.
Now, a pro always looks at both sides. There's no free lunch. By extending the trade, you're extending the duration of your risk. Your capital is tied up for longer, so you have to be aware of your margin, and you have to be sure this longer commitment still fits your overall game plan.
So the next time the market tests you, and believe me, it will, you're going to find yourself at that same crossroads. And the question is simple. What are you going to do? Are you going to react with fear and take a loss you don't have to? Or are you going to execute like a professional? Are you going to panic, or are you going to play the game?